We begin with a special report on auto ancillary major Pricol Limited, examining its latest performance and strategic direction.
In this briefing, we will cover Pricol's headline performance, break down its core business divisions, analyze its growth and margins, examine how it's navigating industry challenges, detail its long-term roadmap, and conclude with a final investment thesis.
First, a look at the company's second quarter performance, which has captured market attention. Pricol reported a significant 52% year-over-year revenue growth in the second quarter, outperforming many of its peers in the sector. It is critical to note, however, that this figure is largely the result of an inorganic growth strategy following the recent acquisition of a plastics business. To understand the company's operations, we will now break down its three main business divisions. The company's revenue stream is diversified across three segments: Driver Information Systems, which accounts for 58% of revenue, the newly acquired Plastics division at 26%, and its Actuation, Control, and Fluid Management Systems, or ACFMS division, at 16%. The largest division, Driver Information Systems, is a market leader in two-wheeler instrument clusters, commanding over 50% market share. This division benefits directly from the industry's shift towards more advanced electronic components in vehicles, a trend known as increasing content per vehicle. The ACFMS division produces critical components such as pumps and brake systems. This positions it to serve both the traditional internal combustion engine market and the growing electric vehicle market effectively. The recently acquired Plastics division expands Pricol's portfolio with body components, like dashboard assemblies and vehicle trims, offering greater cross-selling opportunities to its existing original equipment manufacturer clients. We will now analyze the financial implications of this expansion, specifically its effect on profit margins and future growth projections. The acquisition has led to margin dilution. The core business operates at a 12 to 13% EBITDA margin, while the acquired plastics business currently yields a lower 9% margin. Management describes this as a value investing approach, acquiring an underperforming asset at a low cost with a clear strategy to improve its profitability. The margin on this business has already been improved from 6% at the time of acquisition to its current 9%. Looking ahead, the company projects strong 30 to 35% growth in its high-margin ACMS division, with more moderate growth expected in its other segments. The plastics division's growth is currently capacity constrained. A key indicator of operational strength is how a company manages industry-wide challenges. Here, we examine Pricol's response to supply chain disruptions. Management has addressed the latest challenge, a critical semiconductor shortage from a key supplier, with a proactive strategy. This involved 80 to 90 critical parts. The company has already identified alternative suppliers and secured the necessary client approvals, demonstrating an efficient response. Management states this will result, at worst, in a minor 4 to 5% revenue delay rather than a permanent loss of sales. Shifting to the long-term outlook, Pricol has laid out an ambitious 6-year plan for significant expansion. The company targets a nearly threefold increase in revenue to 8,000 crore rupees by fiscal year 2031. This will be supported by significant capital expenditures of 250 to 300 crore rupees annually over the next 2 years. This growth will be fueled by new business lines, including disc brakes and switches, as well as a strategic move toward backward integration. In-house manufacturing of screens will reduce import dependency and strengthen the supply chain. Finally, we synthesize these points into a concluding analysis of the company's investment profile. In summary, Pricol presents strong business fundamentals and a clear strategic roadmap. This is counterbalanced by a high valuation, with the stock trading at a price-to-earnings multiple of 40 to 42 times. The headline growth is inorganic and expected to normalize to a range of 15 to 20%. This leaves a central question for the market. Does the company's robust long-term strategy justify its current premium valuation?